Hi, I'm Chris Briscoe, Director of Financial Planning, here to talk about everyone's favorite topic when it comes to building a comprehensive financial plan, and that is taxes. As we approach year end, it's important to focus on taxes not only for this year, but also start preparing for taxes in the future due to some big changes that have occurred. To begin, on July 4th, 2025, the One Big Beautiful Bill Act, or OBBBA as we'll call it, was signed into law, bringing important updates and changes to tax policies, savings incentives, and federal spending, all of which can impact your overall tax situation and financial plan. And as if taxes weren't already complex and confusing enough, here we are with more changes to plan around for this year and beyond. Unfortunately, there's limited time today to talk about everything in the bill, but we wanted to highlight some of the provisions, including some existing ones that were made permanent, as well as some new provisions that you may want to be aware of. One of the main tax concerns of 2025 was the current tax rate schedule that had been in place under the 2017 Tax Cuts and Jobs Act, and what was going to happen to that schedule at year end. Without action, these rates were set to revert back to the pre-TCJA tax rates beginning in 2026. And with the possibility of tax rates increasing at the end of this year, tax planning strategies to try to take advantage of lower rates now, like Roth conversions and accelerating income, were front of mind for many. However, with OBBBA being passed, these rates have now been made permanent, which extends the timeline and conversations around tax planning strategies. On the left, you'll see the pre-TCJA rates, and on the right are the rates that have been extended, going from 10% with a top tax rate of 37%. In addition to the tax rates, other items were also made permanent, some beginning this year in 2025 and others starting in 2026. For example, standard deductions had increased significantly under the 2017 Tax Cuts and Jobs Act, and they'll now continue starting this year, with the standard deduction rising to $15,750 for single filers and $31,500 for married filing jointly. Also in 2025, the child tax credit was increased from $2,000 to $2,200 per child, but this credit is subject to income phase-outs. Two changes beginning in 2026. First, the annual gift tax exclusion amount will be $19,000 per recipient, and the estate and gift tax exemption amounts will increase next year as well. In 2025, the amount was $13,990,000. In 2026, the amount will be $15 million per individual. Please note that all will be indexed for inflation going forward, and it's important to also note that while I say permanent, I really mean that these will remain in place or unless they are changed as a future Congress or administration has the ability to initiate change. There are also some new provisions that were passed that are only for a limited time frame, some of which you'll see here. Beginning this year and going through 2028, there's an additional $6,000 deduction for seniors. Those are taxpayers 65 and over. The deduction starts to phase out at $75,000 for single filers and $150,000 for married filers. It's fully phased out at $175,000 and $250,000 respectively. This is in addition to the already additional standard deduction for taxpayers 65 and older, $2,000 for individuals, and $1,600 per person for married tax filers. State and local income tax, or SALT, deductions increased from $10,000 to $40,000. This starts this year and goes through 2029. And finally, the auto loan interest deduction. For new vehicles purchased between 2025 and 2028, and also assembled in the United States, up to $10,000 in interest may be deductible per taxpayer. These are subject to income phase-outs as well. There are some new provisions for charitable deductions for both non-itemizers and itemizers. Beginning in 2026, for non-itemizers, cash donations to charity can be deducted up to $1,000 for single filers and $2,000 for married filers. This amount is not indexed for inflation. For itemizers, charitable contributions can be deducted to the extent they exceed 0.5% of their adjusted gross income. In addition, itemized charitable deductions are capped at 35%, even for those who may be in the 37% tax bracket. This also starts in 2026. Some important changes to 529 accounts as well. If you have a 529 account or are planning to open one, the annual withdrawal limit for K through 12 has been increased and expanded. Pre-OBBBA, there was an annual withdrawal limit of $10,000 per year for K through 12 tuition expenses. Post-OBBBA, beginning in 2026, the withdrawal limit has been increased to $20,000 per year per beneficiary. and it doesn't just cover tuitions anymore. Qualified expenses were expanded to cover non-tuition expenses, including but not limited to curriculum materials, books and other materials, online education materials, and testing fees. Also allowed are tax-free withdrawals for training and continuing education in the workforce. Please keep in mind that state tax treatment may vary from federal tax treatment when taking distributions from 529 accounts, so make sure you consult with a qualified professional. And finally, the creation of the Money Accounts for Growth and Advancement program, better known as Trump accounts, in order to encourage additional savings for a child's future beginning in 2025. Parents and others can contribute $5,000 per year after tax in this tax-deferred account for a child who has not yet reached age 18. In addition, for a child born after December 31st, 2024, and before January 1st, 2029, the government will contribute $1,000 to the account. This is scheduled to begin in 2026, but more to come as far as details for these accounts. The goal is to provide a savings account for a child to be invested in something that tracks a qualified index. In summary, the One Big Beautiful Bill Act is filled with many updates and changes to tax policies that can potentially be incorporated with your overall financial plan. Many of these changes will remain in place for the foreseeable future, so it's important to build your financial plan with OBBBA in mind to see what your overall tax picture looks like now and in the future. Should you have any questions, please reach out to your advisor.